Dividends are more than just periodic payments to shareholders. They are a window into a company's financial health, a tool for rewarding loyalty, and a signal to the broader market about future prospects. Understanding dividends requires unraveling their various forms, the mechanics behind their distribution, and the ripple effects they create in the stock market. Let's explore the landscape of dividends, moving from their types to the intricate process of distribution, and finally, to the impact they have on a company's share price and investor sentiment. At their core, dividends are a portion of a company's profits distributed to shareholders. By choosing to issue dividends, a company acknowledges its profitability and shares the success with those who have invested their capital and trust in its business. However, not all dividends are the same. They come in different forms, each serving a unique purpose and carrying distinct implications for both the company and its investors. The most familiar type is the cash dividend. As the name suggests, this is a direct payment made in cash to shareholders, typically on a per-share basis. For instance, if a company declares a cash dividend of 50 cents per share and you own 100 shares, you would receive $50 directly into your brokerage account. Cash dividends are often paid quarterly, and their regularity is a hallmark of established, mature companies with stable cash flows. Investors who rely on steady income, such as retirees, often prioritize stocks that pay consistent cash dividends, as they provide a tangible return on investment without needing to sell shares. But not all dividends are receive in the form of cash. Sometimes, a company might opt to pay a stock dividend. Instead of distributing cash, the company issues additional shares to existing shareholders. For example, with a 5% stock dividend, an investor holding 100 shares would receive 5 new shares. This approach allows companies to reward shareholders while conserving cash for other business needs, such as expansion or research and development. Stock dividends increase the total number of shares outstanding, which can dilute the value of each individual share, but often leaves the overall dollar value of an investor's holdings unchanged. Occasionally, companies may issue property dividends. These are non-cash assets distributed to shareholders, perhaps equipment, real estate, or shares in a subsidiary company. Property dividends are rare and typically used in unique circumstances where the company prefers or needs to transfer assets rather than cash. The valuation of such dividends can be complex, as the market must determine the fair value of the asset being distributed. Another form is the special dividend, a one-time payout that usually occurs when a company accumulates excess cash and decides to share this surplus with its investors. Special dividends are not part of a regular schedule and often result from extraordinary profits or asset sales. A notable example is Microsoft's $3 per share special dividend in 2004, which distributed billions of dollars to its shareholders in a single event. Special dividends can temporarily boost the stock price as investors anticipate the windfall, but this is usually followed by a readjustment as the payout leaves the company with less cash on hand. Some companies, particularly those facing temporary cash shortages, might issue scrip dividends. Instead of immediate cash, shareholders receive a promissory note, a formal IOU, entitling them to payment at a future date. Scrip dividends are a signal that a company wants to maintain its dividend track record, but is currently unable to meet the obligation in cash. While they allow companies to buy time, scrip dividends may also raise concerns among investors about the firm's liquidity and short-term financial health. Finally, there are liquidating dividends. Unlike other types, liquidating dividends are paid when a company is winding down its operations. Rather than distributing profits, the company returns capital to its investors by selling off assets. Receiving a liquidating dividend reduces an investor's cost basis in the stock, but it also signals the end of the company's existence as an ongoing business. For shareholders, this is often a bittersweet payout, marking the conclusion of their investment journey with the firm. The process of distributing dividends is carefully structured and comprises several key dates that investors need to understand. It begins with the declaration date, when the company's board of directors formally announces its intention to pay a dividend, specifying the amount and the critical dates that follow. Next is the ex-dividend date, typically set 2 business days before the record date. This is a pivotal point for investors. Only those who own the stock before the ex-dividend date are eligible to receive the upcoming dividend. If you purchase the stock on or after the ex-dividend date, the seller retains the right to the dividend, not you. This rule is crucial for those looking to capture dividends as part of their investment strategy. The record date is the cutoff point at which the company determines its official list of shareholders eligible for the dividend. Those recorded as shareholders on this date will receive the payout. Finally, the payment date is when the company actually distributes the dividend, transferring cash, shares, or other assets to shareholders. Dividends also have a direct and visible impact on stock prices. On the ex-dividend date, the stock price usually drops by approximately the amount of the dividend. For instance, if a company declares a $1 dividend and the stock closes at $50 the previous day, it might open at around $49 on the ex-dividend date. This adjustment reflects the fact that new buyers are no longer entitled to the imminent dividend, so the stock's value is effectively reduced by the payout amount. Beyond these mechanical adjustments, dividends influence market sentiment and investor behavior. Regular rising dividends are often seen as a sign of financial strength and stability, attracting income-oriented investors who value predictable returns. Such companies are perceived as well-managed and capable of generating consistent profits. Conversely, cutting or eliminating dividends can signal trouble, suggesting that the company is struggling to maintain profitability or is conserving cash for pressing needs. This can trigger negative sentiment and lead to a decline in the stock's price as investors reassess the company's future prospects. Tax considerations also play an important role. In some countries, dividends are taxed at a different rate than capital gains, affecting investor preferences. For example, if dividends are taxed more heavily than capital gains, some investors may favor growth stocks that reinvest earnings rather than pay dividends, seeking to defer taxes until they sell their shares. In other jurisdictions, favorable tax treatment of dividends can make dividend-paying stocks especially attractive. Over the long term, a company's dividend policy can influence its stock's stability and valuation. Consistent dividends can help anchor the stock price, reducing volatility and providing a measure of confidence during market downturns. However, if a company pays out too high a proportion of its earnings, known as a high payout ratio, it may raise concerns about whether the dividend is sustainable and whether the company is leaving itself enough resources to invest in future growth. To summarize, dividends come in several forms: cash, stock, property, special, scrip, and liquidating. Each has its own use case, benefits, and implications for both companies and investors. The process of distributing dividends is governed by specific dates that determine eligibility, and the payment itself is reflected in the stock price. Dividends can enhance investor sentiment, offer tax advantages or disadvantages, and affect the long-term trajectory of a company's stock. For investors, understanding these nuances is key to making informed decisions and building a portfolio that aligns with their financial goals, whether that's regular income, long-term growth, or a balance of both.